Joining me from Edinburgh is banking credit strategist Harald Eggerstedt from RIA Capital Markets. Thank you very much indeed for joining us. So if we just look at the earnings that we've had so far today, SocGen, Standard Chartered, Lloyds, and indeed the earnings in general, profits are up, bad loans are down.
Yeah, yes, I think compared to last year, we were bound to see that. We had the terrible credit crunch in 2008. It had major effects on the insolvency rates in the 2009, which forced the banks to increase provisioning, which got deducted from their profits. So the profits were poor last year. They are much better this year. It's mainly on behalf of the impairment cycle that's now turning positive. Provisioning is going down. That gives the banks more room to show profits.
Why the slump in investment banking?
In investment banking, we had also a very strong year in Q2 2009. That's because the credit markets froze. Corporates used the capital market to raise funds. The banks did it for them, earned major fees on it. Then the second half, the market normalized. Assets went up. Securities went up in prices. That also showed us profits in the banks. So last year, the investment bank results were very strong, and that is not being repeated this year, particularly because in Q2, we had a weak period with the sovereign volatility in the markets in Europe in particular.
So are falling bad loan provisions enough to offset a slowdown in investment banking revenue?
For now, it seems to be like that. It remains to be seen how the second half goes, because obviously that impairment reduction trend will not last forever. It goes down a bit further. So we'll need a recovery investment banking revenue to keep the positive picture till the end of the year.
And very briefly, we've seen loan losses falling, but do we risk being over-optimistic? Could we see further write-downs in the event of a double dip or indeed an economic slowdown in Europe or the US?
Yeah, that's a very relevant question. I mean, we are seeing the US economy slowing down quite a bit. So if this triggers another weakness in the global economy that undermines the progress made in some companies, we could see insolvencies increasing again in the second half, and that would increase the cost for impairments again. So there is a risk that a double dip would create more problems for the banks. But however, their capital ratios are much improved from last year, so they should be able to absorb that. That doesn't mean a banking risk. It could dent the profits.
Harald Eggerstedt, thank you so much for your time. Appreciate it.